The Mortgage Maze: Why You Might Be Paying More Than You Think. Podcast episode number 18. Welcome back to Retirement Solutions for All Ages. I'm your host, Ruth, the retirement mortgage expert at Nexa Mortgage. I did a special video on the 50-year mortgages, and in episode 17, we talked about strategies for paying down your mortgage faster. Today, I want to take that conversation a step further and tackle a topic that might sound controversial, but one I feel very strongly about. In my opinion, the way traditional mortgages are structured, especially with frequent refinancing, can feel like a maze that mostly benefits banks and mortgage professionals, often at the homeowner's expense. You work hard for your money, and your home is likely your biggest asset. So, why do so many people feel like they're constantly paying into a system that keeps them tied to debt longer than necessary? We're going to pull back the curtain on amortization, look at some surprising statistics, and explore why continually resetting your mortgage might be a trap. This isn't about blaming individuals, but about understanding the system and arming yourself with knowledge. This is a topic I'm incredibly passionate about, even if it means I sometimes lose clients who are set on the traditional path. So let's look at the invisible cost, amortization, and the refinance trap. Have you ever looked at your mortgage amortization schedule? Most people haven't. And that's precisely where the invisible cost of the traditional mortgage lies. In the early years of a standard 30-year fixed mortgage, a disproportionately large percentage of your monthly payment goes directly towards interest and very little towards reducing your principal balance. It's designed that way. Think about it. During the first 7 years of a 30-year mortgage, a significant portion, often well over 50%, of every single payment you make is pure interest. The principal reduction is minimal. This means you're primarily paying for the privilege of borrowing the money, not building equity in your home at a fast pace. Now, let's add refinancing into the mix. In episode 6, we mentioned that the Federal National Mortgage Association, Fannie Mae, states the average American mortgage lasts just 4.2 years before it's refinanced. Why is this significant? Because every time you refinance, even if you get a lower interest rate, you are often resetting that amortization clock. You're starting back at year one, where the lion's share of your payments once again goes towards interest. This means you could spend decades making payments, but never truly making significant headway on your principal, constantly starting over. You're giving the bank another first 7 years of high interest payments over and over again. Who gets rich? Banks? Mortgage professionals? You? So, if the homeowner isn't rapidly building equity, who benefits from this cycle of long amortization schedules and frequent refinancing? Well, the banks and mortgage professionals, for starters. Every refinance comes with origination fees, appraisal costs, title insurance, and other closing costs, contributing to the economy. These are charges that directly benefit the lender and various third-party service providers. While these are legitimate costs for service, if you're refinancing every few years, you're paying these fees repeatedly. It's a continuous revenue stream for the industry. You're effectively paying to reset your debt, not necessarily to eliminate it faster. My passion lies in helping people build their wealth, not facilitate transactions. This means sometimes I even talk myself out of an easy commission. If a client comes to me wanting to refinance their mortgage just to get a slightly lower rate, I'll often ask them to consider the bigger picture, the closing costs, the impact on their amortization schedule, and whether that money could be better utilized elsewhere. It's a challenge to the conventional wisdom, and sometimes it means losing a client who just wants the easy traditional refinance. I will say different states have different costs, so it depends on where you live. But I believe in empowering you to make truly strategic decisions, even if it means questioning the status quo. What's the alternative to being caught in this mortgage maze? It's about taking control and adopting a proactive, informed approach to your largest debt. 1. Accelerate your payoff strategically. As we detailed in episode 16, strategies like making biweekly payments, adding extra to your principal each month, or making an annual lump sum payment can dramatically reduce the amount of interest you pay and the overall term of your loan. This allows you to build equity faster and move towards true financial freedom. 2. Question the refinance impulse. Before you jump into a refinance, ask yourself, what is my real goal? Is it truly to save money over the life of the loan? Or am I just chasing a slightly lower payment without considering the long-term costs? Kind of like a 50-year mortgage. Sometimes keeping your existing low-rate mortgage, even if it's a few points higher than the current rate, might be the smarter play if closing costs and resetting your amortization outweighs the interest savings. 3. Explore creative financing options. Don't limit yourself to the traditional 30-year fixed mortgage. For some, an adjustable rate mortgage might make sense if they plan to sell or refinance before the rate adjusts. For retirees, a reverse mortgage for purchase, as discussed in episode 15, or a traditional reverse mortgage on an existing home can provide immense financial flexibility without monthly principal and interest payments. These options often are misunderstood, but can be a powerful tool when used strategically to align with your retirement goals. The key is financial literacy and a willingness to look beyond the surface. Your mortgage doesn't have to be a lifelong burden that primarily enriches the banking industry. It can be a tool you control to build your wealth. Understanding the true mechanics of your mortgage empowers you to make choices that serve your financial independence, not the bank's bottom line. Don't be afraid to question, to learn, and to seek out options that truly align with your long-term wealth-building goals. If you're feeling lost in the mortgage maze or want to explore creative financing options that genuinely put you in control, let's connect. You can reach me directly by phone at 828-888-LOAN. That's 828-888-LOAN. Or you can email me at ruth@nexamortgage.com. Thank you for joining me on Retirement Solutions for All Ages. If this episode sparked new insight for you, please leave us a review, share it with a friend who might benefit from these strategies, and hit that subscribe button so you don't miss future insights. Until next time, I'm Ruth, the retirement mortgage expert, helping you navigate the mortgage market with wisdom and power.